fundsupermart.com.
What is your outlook on the Malaysian fixed income market post-election?
With the elections behind us and the ruling coalitions, Barisan Nasionals returning to power, the political risk that was the biggest overhang in the market has been lifted. And this is a positive story for our bond market. Just a week after the elections, we are seeing strong inflows back into the MGS market, with yields trending lower, and foreign ownership has been increasing steadily. This huge inflows is reflective of a strong ringgit, which is broken below the three-figure levels. All this trading momentum is also supportive or good for the PDS market, with domestic interests looking for higher yielding bonds and looking to expand their durations. Buying interests, I believe, will be along the AAA and AA rating segment. And looking forward, we believe the asset allocations will continue to shift towards Asia, which has benefited Malaysia, and this will continue to support the lower MGS yield.
What are the drivers in the next 2 to 3 years?
From the fundamentals perspective, we are seeing that the key growth drivers are the domestic demand and also the investment activities. That is the rolling out of infrastructure projects under the Economic Transformation Program. The Barisan Nasional victory in the election should provide policy continuity for the economy. Looking at the buying momentum, we believe the technical will stay strong due to the loose monetary policies coming from the Federal Reserve, the European Central Bank, and also the recently Bank of Japan. We believe the global investor will remain yield hungry, and as such, we reckon that the high foreign ownership of MGS will stay for the near term. Other aspect we can look at, well, Malaysia is still one of the more open capital market in the region, with very low or minimum capital control, and the foreign investors are exempted from paying tax on the bond earnings.
What about the downside risk?
On the risk side, in the near term, the next political milestone will be the UMNO elections. There could be noise in the run-up, and we believe might cause jitters in the market and may shake investor confidence, causing them to pull out from the market. However, this is not our base case. We believe that whoever comes into power will continue to spur the economy for Malaysia. On another risk, which has been for a while, is the Europe debt crisis. There are still problematic issues coming out from the Europe side, and the most recent pertains to the Cyprus bailout. So should the Eurozone fail to contain their debt situation, or to an extent EU member states decide to leave the Eurozone, there will be volatility in the market, and we believe that Malaysia will not be totally immune from the risk.
With regards to the Malaysian fixed income market, how attractive is it relative to fixed income of other countries?
Well, if you look at it, Malaysia's bonds still offer one of the highest real yield in Asia. Just as a comparison, a 10-year MGS offers a return about 1.5% after adjusting for inflations. The same debt maturity in Thailand will offer about 0.1%. And if you look at Indonesia, it will be close to 1%. On top of that, the sound economic fundamentals will continue to make Malaysia an attractive investment proposition.
What is the one advice investors can take away from, especially for those who are currently invested in the Malaysian fixed income market?
I would recommend them to stay invested and also to understand the risk they are getting themselves into, be it the interest rate risk or the credit risk, and of course to do their homework. On top of that, maybe they can look beyond the Malaysian market, i.e. the Asian space, as a diversification play for them if they suit their risk-return profile or investment objective. In the Asian space, again, we are comfortable with the hard currency, i.e. the US dollar market, whereby the Asian corporates issue bonds and tapping the market at the current moment.